In the previous module, we were looking at equity accounting, and that was the treatment for associates, where we have influence but not control, and joint ventures. And if you remember, we said that we do a one-line consolidation. In other words, there's only one line that appears in the investor's account for the associate, one line in the balance sheet, and one line in the income statement. Well, in this module, we're going to continue on looking at equity accounting, but we're going to talk about impairment and transactions between the investor and the associate. In particular, we're going to talk about the investor selling goods to the associate, a downstream transaction, or the associate selling goods to the parent, an upstream transaction. We're going to start off by looking at impairments. Okay, so equity method impairment. Now notice IFRS says fair value below carrying value, US GAAP says fair value below carrying value. There is a slight difference in terminology. IFRS says not temporary and US GAAP says permanent. And I would be a little bit careful with fair value. If you remember back to your level 1 studies, US GAAP always compared fair value to balance sheet value. IFRS compared the higher of fair value minus any disposal costs and value in use. And actually, strictly speaking, it's going to be the same here. Okay, so let's talk about what we're likely to be seeing in the balance sheet. What is our carrying value made up of? Okay, so carrying value, remember, just means balance sheet value. So our balance sheet value is going to comprise of our share of the book value of the associate's net assets. And remember, that's at the date of acquisition. So when you acquire it, you look at its book value, balance sheet value of its net assets, and bring in your share. But remember as well, at the date of acquisition, we also have to make fair market value adjustments. So we'll bring in our share of any fair market value adjustments we make. Those two combined mean we brought in our share of fair market value net assets of the associate. Now, the difference between the fair market value of net assets that we've acquired and the price we pay, of course, is goodwill. So we've got goodwill. Okay, and remember, those take us to purchase price. And that's fine at the date of acquisition, but what if we're looking at some time down the line? Well, of course, if you remember back to the previous module, each year we brought in our share of the associate's net income minus our share of its dividends. And we do that for every single year. So we're bringing in our share of cumulative net income since acquisition minus our share of cumulative dividends since acquisition. Well, that's the same as saying we're bringing in our share of the change in its retained earnings, okay? And that will give us our carrying value. When I say change in retained earnings, I mean the retained earnings from the acquisition date to the current point in time. So that's the carrying value. Now, what US GAAP does is it looks at the carrying value and compares to fair value, okay? And it says we must hold at the lower of these two amounts. And that's US GAAP. What is fair value? If you like, it's sales price. What we think the associate investment would be worth if we were to sell it in an arm's length transaction. Now, of course, by definition, that is going to be a subjective figure. You're not going to know essentially what the sales price is. So just be a little bit aware. Well, look, a lot of subjectivity around that figure. So it's sales price in an arm's length transaction, meaning on proper commercial terms. So that's what US GAAP uses. But remember, with IFRS, rather than looking at fair value, it uses the higher of two figures. And you'll remember this from level 1. One was fair value less any disposal costs. Sometimes they call that FLCOD, fair value less costs of disposal. So any costs you would incur in actually selling the investment. And the other one is value in use. Now, yet value in use is going to be our share of any future cash flows the associate is expected to generate. So maybe we're looking at some form of free cash flow type model here. I don't think they're going to try and trip you up on that under IFRS, but it's worth having it at the back of your mind. It isn't simply compare carrying value to fair value. It's actually compare carrying value to the higher of fair value less any cost of disposal or value in use, whichever is the higher of the two. Okay, let's return to our slides and make sure we can tick off all of the other elements on this. So as I mentioned, IFRS refers to it as being a decline where fair value is below balance sheet value, and we don't think it's temporary. It's not going to reverse in the foreseeable future. Okay, whereas US GAAP, very similar. In other words, fair value has declined below carrying value, but they use the word permanent. Now, I don't know about you, but permanent sounds more than simply temporary. Temporary sounds like, well, we're not expecting it to reverse in the foreseeable future, but it might do at some point in the distant future. Whereas permanent seems to be, well, look, we're not ever expecting it to recover. Now, IFRS looks for objective evidence that there has been an impairment. Number one, it's going to look for a loss event. Some event that gives you an indication that your associate might be impaired. It could be, for example, losses of major customers. It could be a competitor launching a product that substantially makes the associate's products obsolete. Some key event that is going to affect either revenues, it's going to either decrease future revenues or increase future expenses. Now, the key point is it must have an impact on future cash flows. So these loss events must affect future cash flows, in fact, reduce future cash flows, and we must be able to put a reliable monetary amount on these. So all three are needed under IFRS. You have to have a loss event. It has to have an impact on future cash flows, i.e. reduction in future cash flows, and you need to be able to put reliable measurement on that, i.e. substantiate in monetary terms what the decrease is. Now, what we're going to do is write down the asset to fair value under US GAAP. Of course, under IFRS, it would be writing the asset down to whichever is higher, fair value less any cost of disposal or value in use. And the difference, this reduction, we're going to reduce the balance sheet asset. So down goes our balance sheet assets with the impairment. In fact, impairments are rather like gigantic kind of depreciation expenses, you can think of them as. Now, if our assets have gone down, if we think about our balance sheet equation, assets equal liabilities plus equity, we've just said our investment, our carrying value of our investment has been written down to its recoverable amount. That means either liabilities or equity is going to need to fall as well. Well, the idea is, remember, the impairment loss is recognised in the income statement. Now, if it is material, i.e. significant enough that we need to bring it to the attention of our shareholders, then it will be on the face of the income statement. And if you remember back to level 1, it will be treated as an unusual or infrequent item. If it's not material, so not that significant, then maybe the impairment loss is hidden within costs of goods sold if it relates to the productive infrastructure the firm is operating with, or essentially in sales, general and admin. But the key point is it's going to go through the income statement. Now, of course, if it goes through our income statement, it goes through as an expense. It therefore reduces net income. And if it reduces net income, it reduces retained earnings and hence stockholders' equity. So that is how the balance sheet all still balances. Asset falls by the impairment. Okay, equity also falls by the impairment via net income impacting retained earnings. Now again, big difference between US GAAP and IFRS. Notice what happens if fair value recovers in a future period. What happens if fair value goes above that original carrying value? Well, notice under US GAAP, no reversal. No reversal under US GAAP. So you cannot essentially report it as income in a subsequent period and increase the value of the asset in the balance sheet. However, under IFRS, we are allowed to reverse the amount of the original impairment. So you can reverse the impairment and increase the asset back up to its original value. Now, goodwill, it says, is not separately tested for impairment. And the reason for that, if we just go back to our carrying value, remember, we are testing this figure in the balance sheet, okay? And notice, well, goodwill is a part of that. But remember, you do not see goodwill separately. Remember this concept of a one-line consolidation. This is the only figure that we see when we look at the investor's balance sheet if they're using equity accounting. So we don't see goodwill separately. It's not reported as an intangible asset separately. We don't therefore test goodwill separately, but we are testing it because we test the entire carrying value against fair value.
Now, transactions with associates. The issue here is because we have influence over the associate, we could use this to influence the terms of any transaction, the sales price, and of course timings of any sales transactions between the two entities. So the idea here is we're a little bit concerned that sales between the parent company and its associate might not be on proper commercial arm's length terms. Now, they talk about upstream profits and downstream profits. Upstream profits, notice the profit on the transaction is in the associate's accounts. In other words, therefore, the associate must have sold goods to the parent, and therefore the profit is in the associate's accounts. Downstream transaction, here the profits are in the parent's accounts. So therefore, the parent must have sold goods to the associate. Now, quite why we make this distinction is a little unclear to me, because actually the way we're going to account for this is identical whether you're looking at an upstream profit or a downstream profit. So let's have a little look, therefore, at our issue. Now, remember, the issue is, are these transactions on proper commercial arm's length terms? We worry that they might not be because by definition we have influence over our associate. So what we're asked to do here is take a pro rata share of the profit not confirmed from resale or use and eliminate it from the equity income. Okay, let's break that sentence down to make sure you're clear on what's happening here. Pro rata share. Hey, look, if you own 30% of the associate, then your pro rata share is 30%. So we're going to have to eliminate our share of the profit that hasn't been confirmed from resale or use. Now, of course, if you sold those goods on, we've now confirmed the price by a sale external to the two companies to third parties, which will be arm's length. Okay, or if we've used them up, again, in our production process. What we're worried about is those goods that haven't been sold that might not be at commercial terms because we haven't confirmed that profit by any third-party transaction. So what we need to do is eliminate any profit that's not been confirmed from resale or use, and we're going to eliminate it from our equity income, the income in our income statement. Let's have a look at this. Now we're going to see that the treatment, as I said, is exactly the same in both cases. Whether you're looking at an upstream transaction or whether you're looking at a downstream transaction, we're going to make the adjustment to the equity income. Now that seems fine to me if I'm looking at an upstream transaction because the profit on the transaction was in the associate's accounts. Seems a little bit odd to me if it's a downstream transaction because the profit is in the parent company's accounts, but we're making the adjustment to the associate's earnings, essentially, which seems a little bit of a mismatch to me, but that's how it's done, and that's what you need to do in the exam. So don't worry that downstream seems a little odd. So let's start with an upstream transaction. So our investor owns 30% of the investee. So the investor, the parent, the investee, the associate. During the year, the investee sold goods to the investor and recognized a profit of $15,000. At year end, 50% of the goods remained in the investor's inventory. So 50% of the profit has been confirmed by external third-party sales on an arm's length basis, but 50% of the profit hasn't been confirmed. So look, let's take 50% of the profit. So the unconfirmed profit is $7,500. That's our unconfirmed profit. Our share of that, 30%, and we get 2,250. So we're going to reduce the net income in our one-line consolidation in the income statement by 2,250, our share of the unconfirmed profit. Let's have a look at a downstream transaction. Now again, as I said, downstream transaction, yeah, all right, the profit is sitting in the parent company's accounts, but we still adjust the equity income from the associate. So it seems like a mismatch to me, but we're going to be all right with it. Okay, so the investor owns 30% of the investee. During the year, the investor sold 40,000 of goods to the investee for 50,000 and recognized a profit of 10,000. And remember, that's all showing up in the parent company, the investor's accounts. At 10%, at year end, 10% of the goods remained in the investee's inventory. So we take our profit, there's our profit. Our share of that profit is going to be 30%, but remember, we only need to eliminate the unconfirmed profit. So 10% of the goods remain in the investee's inventory, 90% have been sold, 10% haven't, so the unconfirmed profit in this case is going to be $1,000. $1,000 times 30% gives us $300. And remember, we're going to adjust the associates' earnings rather than the parent company's earnings. So we're going to reduce the investor's equity income coming from the associate. We're going to reduce it by $300. Fair value options, just be a little bit aware, we can choose to not use equity accounting at all and say, hey, look, I'm not going to use equity accounting. Instead, I'm going to record at fair value. So here, the balance sheet investment is now at fair value, and any changes in fair value at year end are taken to the income statement as unrealized gains and losses. In other words, we've got the election to treat this really as if it was a trading security. Now, US GAAP allows you to do this for all associates. Okay, IFRS limits it and says, okay, hey, you can use the fair value option for associates, but only venture capital, mutual funds, and unit trusts. And I kind of get why, because essentially under IFRS, fair value is going to be approximately equal to net asset value, assets minus liabilities. Because look, these are investment funds. So a lot of their assets in their balance sheet are going to be at fair values rather than historic costs. So it kind of makes sense why IFRS says, hey, yeah, we'll allow you to do it for these types of companies, because we can pretty much approximate fair value. But what about associates that don't have a lot of assets in their balance sheet close to fair market value? Well, trying to establish their fair value is going to be tricky unless they're a listed company. So what about unlisted companies? Well, we're going to rely on some kind of valuation methodology. And then, of course, things start to become sketchy. But nonetheless, US GAAP allows you to do it. Notice, once you've chosen to use the fair value option, you're stuck with it. You're always going to record at fair value in the balance sheet. You're always going to take your unrealized gains and losses to the income statement. Right, let's finish up our analysis of equity accounting by looking at analyst issues. Is the equity method appropriate? Do we really like it? First of all, of course, remember, you can't just use that bright line criteria, 20 to 50%. The key point is influence. So you could only have one share, but if you had influence over the company, you still should be treating it as if it was an associate and equity accounting. Likewise, you could have over 50% of the shares, but not have any control over the entity. So again, you should be using equity accounting. Issues in the balance sheet. We don't like the one-line consolidation. Remember what we're doing in our one-line consolidation. Let's think about essentially our year-end investment. It's made up of the goodwill figure. It's made up of our share of fair market value net assets at the acquisition date, and it's made up of our share of the change in net assets. And the issue is net assets, we're saying in each time. So we're saying, look, net assets here, net assets here. We're netting assets against liabilities. Do we like netting assets against liabilities? Well, not really, okay, because essentially we're not seeing the full liability position or the full asset position. In particular, what we're going to do is understate things like leverage. Now, we should be aware that companies like Enron rather abused the equity accounting method to equity account special purpose vehicles. Now, the issue with equity accounting a special purpose vehicle is it has fairly high assets, but its liabilities, the asset-backed securities that it typically issues, are almost identical to the asset values, maybe slightly lower. So net assets are tiny for special purpose vehicles. We talk about them being thinly capitalized, meaning they've got very low net assets, very low stockholders' equity. So when you look at your share of net assets, which is essentially what we're seeing when we look at our equity accounted investments, for special purpose vehicles, they were very, very small figures indeed. Now, the issue particularly in Enron was it cross-guaranteed the asset-backed securities that its special purpose vehicles had issued. Therefore, if the special purpose vehicle couldn't service the asset-backed securities, Enron was obligated to do so. So given that Enron had all of the risk of servicing the debt, bit of a shame that we didn't see the full liability position of those special purpose vehicles when we looked at Enron's accounts due to equity accounting. So we're really, if you like, really don't like this idea that assets and liabilities have been netted against each other. In the income statement, of course, we're bringing in simply our share of net income. Now, again, remember, typically for the CFA exam, treat that share of net income as being in the income statement after the tax line. Actually, the accounting standards give us much less guidance to that, but as I said, to get a future learning outcome statement correct, you're going to need to assume that your share of the earnings from the associate come in after your tax line. So we only show our share of net income. We don't show our share of sales, our share of costs, etc. Now, this as a result is typically going to lead to very weird and distorted profit margins. Think about your net profit margin. Net income over sales. Now, our net income essentially is going to be the parent company's net income plus our share of the net income from our associate. But when we look at the sales figure, all we see is the parent company's sales. So therefore, you're going to get distortions to things like your net profit margin. Also, we have an earnings quality issue. Why? Because we are bringing in our share of net income, but what we're receiving is our share of any dividend that the associate pays. So what this means essentially is we're reflecting earnings in our income statement that are not backed by cash. And it's very critical to the Level 2 syllabus that our examiner views any earnings that are not backed by cash as being of low quality. Okay, so that is the issue that we have with that.